called this edifice Chicago Economics for shorthand, though this is not entirely fair to Greenspan, who had a strong dose of Schumpeter in his intellectual makeup. But I think Chicago Economics is a reasonable, short description of the dominant economics of the last 3 decades, taught in universities and business schools and knocked into the heads of bankers and asset managers. Its main idea is that markets don't get things wrong, and governments usually do. Markets are efficient, shares are always correctly priced. In the name of these doctrines, financial and other markets were extensively deregulated, governments pushed aside, capital left free to roam the world in search of the highest returns. The era of boom and bust is over, declared no less than Gordon Brown. He doesn't use that language today, neither does he use the language of prudence, which was his code word, his favourite word for all the time he was Chancellor of the Exchequer. As Paul Krugman says, this Chicago economics was a romanticised, sanitised version of economic life, which led economists and policymakers to ignore all the things that could go wrong. Economics went astray because, I quote Krugman, economists as a group mistook beauty, clad in impressive-looking mathematics, for truth. Now, it's obvious, I think, to any historian of ideas that these Chicago doctrines were an updated, super-mathematicized version of the ideas Keynes had challenged 70 years earlier. Politicians, regulators, bankers, money managers, financial journalists became slaves not to defunct economists, but to a cluster of Nobel Prize-winning economists who held chairs in the vicinity of Chicago University. The practical men were simply following the latest fashion in economic ideas. Things have speeded up since Keynes's day. Nowadays, you don't have to be defunct to be fashionable. You just need to be regressive, provided you can dress up your regressive outlook in maths. Keynes said 4 things which he thought were obvious. He said these were obvious ideas in the general theory. First, we don't know nearly as much about the future as we think we do, and therefore financial markets can crash. Alan Greenspan admitted the truth of this when he said that the crisis was caused by the, I quote, underpricing of risk worldwide. That could not have happened had financial markets been efficient. Second, Keynes said that when markets suffer big shocks, they don't self-correct quickly, but start shrinking like a leaky balloon as people stop spending. We've just experienced such a shrinking. In the last year, the American economy has shrunk by 7%. Americans are $800 billion poorer than they were a year ago. When America sneezes, this is still true today, the world catches a cold, and the world economy has deflated, more or less in line with America's. Britain's by 5.5%. Third, Keynes said that to make up for the decline of private spending, governments should inject extra spending into the economy. Keynes is the original inventor of the stimulus. This is in striking contrast to what happened between 1929 and 1932. Then, governments didn't believe that contracting economies might need stimulating. They did what they normally did, balanced their budgets and kept money tight, hoping that this would restore confidence. As a result, the American and the world economy experienced 12 successive quarters of contraction. This time, governments did the opposite. They did stimulate, and the contraction has been limited to 4 months, with green shoots of recovery, as everyone tells us, sprouting out all over the place. Finally, Keynes said that the market system needed central management if it was to work for everyone's benefit. There's one very important passage in the general theory which opens its last chapter, and in it Keynes wrote this: "The outstanding faults of the economic society in which we live are its failure to provide for full employment, and its arbitrary and inequitable distribution of wealth and incomes. The bearing of the foregoing theory, that's the theory of the general theory, on the first of these is obvious, but there are also important respects in which it is relevant to the second. The general theory, in other words, sets out to explain the fact of persisting mass unemployment. Its subject matter was not the arbitrary and inequitable distribution of wealth and incomes, which we associate with the Marxist and more generally the socialist critique of capitalism. In policy terms, Keynes wanted governments to make sure that there was always enough aggregate demand, private and public, in the economy to maintain full employment, but he also thought it would be much easier to do this if wealth and incomes were more equally distributed, and I'll come to that later on.